Welcome back. Post the GST cuts, we saw NBFC stocks like Bajaj Finance run up on hopes there will be more consumption and more consumption loans. Logically, banks should also benefit from such a consumption growth, but banking stocks did not react immediately after the news. To assess the outlook after the bunch of government steps to spur consumption, I have with me an ace banker, Managing Director and CEO of Federal Bank, Mr. KVS Manian. Good morning, Mr. Manian, and thank you very much for coming to our studio. It's still only 2 days after Onam, so happy Onam to you as well.
Thank you, same to you.
Well, let's start with this GST rate cuts. Do you see consumption getting a boost?
So I do hope that the consumption gets a boost, though of course there will be some hold on to the demand for this month, I guess, most part of this month. But hopefully from the next quarter, we'll see some impact in demand. The way I look at it is this is good from demand perspective. Interest rate perspective, I am not yet sure where it goes.
Yeah, I'll come to that, cost of deposits and interest rate cuts. But just to finish the growth argument, you know, your best performing sectors were commercial banking and CVs. Those were the two pillars in the just ended quarter.
Right.
Would you expect that CVs will do well simply because the cuts have come?
Yeah, so CVs, it's good for CVs, that is one. But Latha, the way I look at it is we are still a small player in CVs, so we should do well irrespective.
Okay. Oh, irrespective.
Yes.
And what about commercial banking? Do you think that the consumption can spur more? From commercial banking are still large SMEs.
Yes.
Or MSMEs.
Yes. So, I am more, if you see our last quarter also, we have put more emphasis on the commercial banking, and the small business have still grown slightly lesser than that. Because we are feeling more confident about the large SMEs. Okay. The tariff impact on small SMEs, we are kind of wanting to assess that, what the implications of those will be. And as you know, many people in the industry have called out, though our book is not showing any signs of stress. Many people have called out stress in the
Finance Minister has promised
SME.
A package.
Yes.
So she spoke to our channel.
Yes. So I am hoping that that part also picks up. But commercial side, the larger SMEs, I think we are very confident. Our book is very good, and we want to continue to grow that book.
Okay, so let's come to a number. How do you expect credit growth for the full year, for this quarter, for next quarter? Any numbers you can give us?
So, Latha, we've been guiding that we will grow at 1.2 to 1.4 times the nominal GDP growth. Of course, nominal GDP has taken a hit just now, but I'm assuming that through the next 2 quarters, it will normalize a bit. So, we continue to keep that guidance as
1.1 to 1.2 times.
1.2 to 1.4. If the credit growth is muted, we'll probably operate at the lower end of this. Otherwise, we'll operate at the higher end of
Okay, now let me come to the cost of funds. Have you all seen a fall?
Yes, of course. Of course, we have seen a fall. As you know, we dropped our savings rate also and term deposit rates as well. And we have continued to grow our deposits in spite of that. So we have seen a drop in funds, cost of funds. Last quarter, if you looked at our numbers, our cost of funds dropped by more than 18 bips.
So did the NIMs.
So did the NIMs. Of course, NIMs, as you know, are dependent on, nowadays, most banks have 40 to 50% of their book in the repo linked assets, and it's a natural drop.
Loan.
So we are hoping that the fall in cost of funds continues, because the deposits will continue to reprice till April, May. Okay. So we think it'll...
Another just near-term number, if there is no rate cut, what are your NIMs likely to be now and by the end of the year? If there is another cut, which can happen because of the CPI fall, then what are your impact on the NIMs now and end of the year?
Right. Again, Latha, we have guided that up. Post our last quarter, we said that we are close to the bottom of our NIM and ROA trajectory. Because if you know, we reprice T+1 basis. The day repo drops, we reprice it on the same day. There are banks that go up to 90 days on that. So we've taken large part of the fall already. And therefore, we think we are close to the bottom. We had guided that not less than 5 to 10 basis on the NIM side.
So 2.94 can become 2.85, not lower than that.
Yeah, not more than that. I mean, hopefully.
But when does the U come?
So I think we should see uptick from here on.
Second quarter itself?
Second quarter, like I said, there may be small impact, but after that, the next 2 quarters of the year, we should see an uptick on both ROA and...
So your year-end NIM could be over 3?
Yes, of course. Yes.
Okay.
Surely.
Okay. So now let me come to the MFI issue, which obviously showed up in higher slippages for you, higher credit cost.
Yes.
What's the sense?
So, as you know, if you saw our last quarter, there are 2 things I want to talk about. One is the increased credit cost we took was primarily because of MFI. If you looked at the slippages of all the other non-MFI assets, they were exactly where they were 1 year back. Our slippage was 0.77% sans the MFI thing. It remained exactly the same 1 year later, 0.77 to the second decimal.
Okay.
So the primary increase in credit cost came out of the MFI business, where we feel the peak has already happened. May was our peak month. We have seen drop in slippages since May, June, July both. August we have not gone public with the data, but June, July we have seen a drop, and we think we are past the peak on that.
Okay.
And we've also guided that in spite of the fact that we took a 65 basis credit cost in the first quarter, our annual guidance on credit cost remains 55 bips. Okay. So we have not changed our guidance.
You expect the provisioning to come down?
Yes.
I mean, loan loss provisions to come down.
Yes.
What about MFI? I mean, we just had a note from CRIF. They were a little, MFI, MSME and SME.
Right.
They were a little worried. They are seeing trouble. So do you think MFI goes down, but business banking, for instance, can show more...
So like I briefly mentioned earlier, we aren't seeing any stress in our SME portfolio, business banking portfolio.
Okay.
But having said that, it is an area that I want to tread cautiously for sure, because like I said, people have called out stress, and there are small SMEs which can have impact due to tariffs, and hopefully the package that the government is talking about happens, then it will give us comfort. But just now I remain cautious, but I'm still optimistic. It's not that we don't want to grow that book. We want to grow that book, but we will be relatively more cautious at the lower end of SMEs than at the upper end of the SMEs.
Okay. So overall, what is the ROE guidance now? Now, after the new developments in tax cuts, new developments in tariffs, what is the ROA guidance?
So, like I said, we have probably seen the bottom of our ROA journey just now in this rate cycle. Of course, subject to no more new rate cuts. I think we should see an uptick from here.
Okay. No, I'll tell you why. Because this quarter, you all are not going to get other income. Your last quarter for all the banks, although net interest income fell, this other income component, because of the rise in bonds, helped.
Yes.
But this time there will be bond book losses.
Yeah. So, Latha, if you looked at our last quarter, our pure fee-based income also grew by more than 20%, 21% actually.
Yeah.
So we are also growing our fee income strongly. So yes, you are right that on the prop side, there may be some impact of the higher interest rates. But, you know, these higher interest rates, as you know, this has been range bound, right? 20 bips here, there, and you don't know when it retraces back, the interest rates retrace back. If the next CPI call is lower, you never know the interest rates.
The CPI call is going to be lower. So I think bankers have to be prepared for a larger possibility of another cut. I mean, we can't read the RBI.
Right.
But if most economists are pricing in a cut, therefore, what is the ROA trajectory? So
the further cut will impact ROAs. There is no question about that. Again, we should be clear that will be the case. Having said that, you know, there are 2-3 things we are doing. One is, if you see our dependence on floating rate assets is going down. 1 year back, 53% of our assets used to be floating rate. Today, they are 48%. Okay. So we are also, reducing that. Okay. So these should help us, mitigate the impact of falling interest rates. Of course, we are also trying to change the mix of our liability side into more CASA, which also you have seen last quarter, the results have been good on that.
Oh, yes.
So I would say mix of things. There will be things we will do to defend the drop, but there will be some impact, of course. And if you notice our last quarter results again, the drop in NIM that we reported was significantly lower than most analysts expected, right? Because of all these cost of fund drop and the mix change on the asset side, all of that is also playing out. Okay. So we'll continue to do our best on all of that.
Okay. Anything we should know about your subsidiaries, the NBFC or the insurance? Any other activities that you are planning?
On the insurance side, as you know, we have an approval to take our stake from 26 to 30%. We are in the process. Yeah. So we have both the approvals in place now. RBI as well as IRD approval is in place. So we are in the process of executing that transaction. So we'll take our stake to 30%.
And on FedBank Financial Services?
On FedBank Financial Services, it is status quo. Nothing, no plans.
And no capital raising either?
No capital raising either.
Okay. No, I mean, even for federal?
Even for federal, not just now.
Not just now, as in, how long will your capital last?
No, so I think we are at 16% capital adequacy just now. So I think we are okay. Something like a year we can do without capital raise.
With this kind of growth, yes. Okay, and finally, you gave us a 2028 ROA goal.
Right.
You want to refresh it?
Yeah, no, so...
that was the 2% goal.
It is not exactly 2, but ROA 2 is a bit high. But I would say 1.5 kind of an ROA is what we want to aim for in the next 2 to 3 years. And that's what we said in our February analyst presentation. And that's the direction we are moving in. Of course, the number is important. But, it depends on the macro, what the overall industry ROAs look like and all that. But, yeah, we are directionally headed towards the 1.5 and 14-15% ROE, 1.5.
We do hope by 28, a lot of the tariff uncertainties at least will settle down.
Yes.
And our growth path will be far more clearer.
Yes.
Thank you very much.
Thank you,
Manian,
Latha.
for
Pleasure
dropping
being
into
here.
the studio and for chatting with us.
Thank you so much. Pleasure being here. Thank you for having me.
Well, we have to wrap up on Bazaar on that note. Chartbusters coming up after the break.